Welcome, everyone. Hi, Daniela. Nice to see you. Where are you logging in from? And as people are jumping in, I think I'm going to give people about 3 to 4 minutes to just get situated and we'll get going. Hi, welcome. Welcome, Usiakimi. Nice to see you. Hey, Ramon. Oh, Texas people in the house representing. I hope everyone is getting ready for the holidays. It's a little chilly over here. I could use some Texas heat right about now. Hi, everyone. As you're coming in, I just want to give everyone a few minutes to get situated, to get settled, and then we will get going. Welcome, everyone. If you're just logging in, we're going to give everyone a few minutes. I'm thinking 2 more minutes and we'll get the show on the road, which I'm pretty excited. Hi, Mona Lee. Oh, nice to see you. And everyone, please ask questions. I'm going to repeat that over and over and over again. As many questions as you can get, as I can get. I'd love to answer it. I'd love to give value, just to kind of all increase our knowledge and our awareness. Hi, Tiara. Glad you're here. Aw, thank you. Okay, we said in a few minutes we'll get started. If you're just joining in, you could, the chat is open. The questions are also open. Use whichever one you want to toss in questions, comments, say hello, say hi, say where you're coming from, and we will be starting in 1 minute. Hi, Danielle. Nice to see you. Tuning in from Maryland. Yeah, oh, another cold state. Okay, so all the Texas people and the Florida people where it's warm, wear a little jelly. You know, when you're watching the time, it seems to crawl. Okay, it's 6:05. Let's get the show on the road. For those of you who are just joining, welcome. I'm happy to have you here. We are going to get started. So, like I said, welcome again. Before I start, I just want to take a second and I want to ask you a question. I want you to think about what I'm about to share with you. What I'm about to share with you will really challenge everything that you think or you know about building lasting wealth. And by the end of this presentation, you will better understand why the ultra wealthy seem to effortlessly preserve their wealth while others are struggling. First of all, I want to say thank you to everyone who's joining me on this Thursday evening. I'm just happy and I'm grateful for all the support. And I hope that this is bringing you a ton of value because at the end of the day, we want to figure out really how to preserve wealth. While others are struggling, we're not going to be that person. So my name is Dr. Nkem Ezamama. I'm an ER physician and I'm based out of Nashville, Tennessee. I am the CEO and founder of Phoenix Capital Investment. And really our goal is to just help busy professionals build wealth through passive income in real estate. So welcome. I'm excited to have you here. I said this before, I'll say it again. Use the chat, ask questions. If you want to ask questions in the questions section, you can use the chat, just engage. I will keep an eye on it. And so I'll refer to it if you guys have any questions, immediate questions that I can answer. So This is a shocking statistic, which is that 70% of wealth is lost by the second generation. And it represents millions of families who thought that they were doing the right thing. And like I've seen traditional investment advice fail to address this reality, which is that it doesn't last past the second generation. I do want you to recognize that there is a better way, and that's what we're going to talk about today. So while most investors are chasing returns, right, the ultra wealthy investors, they're focusing on something that's entirely different. And there's a reason why certain families maintain wealth for generation after generation. And the question is, how are they doing it? In the next few minutes, more like in the next 60 minutes, we'll be able to discover some of those secrets. And what I'm excited about is that I want to share with you to really explain to you why many ultra wealthy investors are making certain moves right now. So in the market right now, we're seeing kind of three critical market conditions that are converging for the first time since like around 2010. Interest rates are at a pivotal point right now. There is a market hungover from a ton of speculation, like, is this the right time? Is this the wrong time? And then we're seeing a lot of demographic shifts that are creating unprecedented demand. And I'll specifically talk about that. But what you're seeing is that most investors are still focused on the headlines, which is what's happening with interest rates, banking issues, market volatility. But if you notice, the ultra wealthy, the super wealthy, they're doing something different. They're seeing opportunity in the chaos. And that's very important for you to realize and for you to understand. And that while there's frenzy, people are still investing, people are still buying because assets are still available. That is exactly what I'm going to focus on. And I'll show you exactly what they're seeing and why this particular moment is so crucial in wealth preservation. Let me just tell you right now, I will throw out a lot of numbers. There will be a lot of math, but it's important because we are talking in millions. So I want you to think about a pressure cooker, right? It's building so much steam. And each of these forces, they create opportunity. But when they converge together, then they really start building generational wealth. That's when we start creating generational wealth. So for interest rates, right, we're seeing something fascinating in the rate environment. While there's panic about the high interest rates, it's slowly coming down, but the ultra wealthy, they're seeing periods to lock in exceptional deals. You have to know this because they know this, that the rates are cyclical. So like they will come down, they'll come back up, but they'll come down again. But these good assets are forever. So like when you find the right asset to dig in, you should. And you also notice that with the market correction, right? The correction that we're experiencing, it's almost following a predictable pattern. In every cycle, there's that sweet spot where, you find some institutional quality grade assets that become available at a significant discount. That's a window that we're in right now. And so you should be very aware of that. But here's what makes the cycle a little different, right? We're experiencing this weird demographic shift in US history. And we're seeing like 72 million millennials are entering this prime renting years. So, and then also think about baby boomers who are downsizing at the same time. And this isn't all speculation. So it's math. When you look at these three factors, notice how like one is affecting the other, right? That's exactly how like wealth is created massively. It's in these previous cycles, but it's only for those who recognize that and then act on it. So now I want you to think about where we are today, right? Fast forward to 12 to 24 months when the markets have all shifted and all these opportunities have passed. Those who acted 12 or 24 months ago, those who secured those positions, they will start generating wealth, and they're not just doing it for them, they're doing it for generations to come. So it's like the right time is what's the most important. And I'll say it again, like there is opportunity in chaos. You just have to be really aware of that. Also, it's the end of the year. So as you're listening and as you're thinking, what are you doing to get yourself ready for these market forces that are about to converge and they're already convergent? What assets are you investing in? What are you thinking about joining? So I want you to look at the last three market cycles, right? Think 2001, 2008, 2020. In each case, we saw a clear pattern, right? You saw stocks that were dropping at an average of like 35 to 37% during those corrections. But if you notice something, institutional real estate, so apartments, they remained remarkably stable. If you look at the 2008 financial crisis, right, the S&P 500 dropped over 50%, around 52%. But if you looked at what happened to like well-positioned real estate properties during that same period, they did not only like just preserve their capital, but they actually increased in value. And so like and if you also think about something, right, the ultra wealthy, they hate volatility. So while we are typically allocating like 30 to 40%, I'm changing, to portfolio classes such as stocks and bonds, they are doing a lot more than that in hard assets and real estate. But one thing they're also not trying to do is that they're not trying to time the market. They're trying to transcend the market. So that's really important for you to remember. It's like, we are not trying to time the market. We're just getting educated so that we know the right time to invest in, and then just wait. One of my long-term investors said this, and he said something that was really profound. He said during one of the prior market crashes, right? He said, I never worried about my real estate investments. I was just too busy collecting rent checks and distributions. That's what we want. That's what, like, let's position ourselves so that we can say that in the future. So I want you to pay close attention. The next two slides are pretty important. And these are the three key foundational principles that every ultra wealthy portfolio needs to have, and you need to remember this. So you have to think preservation first. And here's what that means in real numbers, right? If you think about a traditional approach where you're just like your maximum return, the results are like you are investing because you're thinking short term, you're investing in maybe things that are a little bit more highly volatile. So think 25 to 30%. But if you take those same certain risks, right, you can have up to 40% drop in bear markets. But the ultra wealthy, their approach is a little different, right? They are saying that the losses that they're willing to really accept is more like a 15% loss, but they require that their income coverage is like 2 times their expenses. But their minimum liquidity, they have to make sure it's about 24 months. And then when you risk adjust for what I just told you, you're looking at still making anywhere from like 12 to 15%. So if you look at like a $10 million portfolio on preservation, right? 4 million of that is in income producing hard assets. That's like about like 8% in cash flow. And 3 million of that is really in like private credit. So you're still getting like 10% yield. And about 2 million is in like strategic positions. So think about that. Like, you always have cash flow. That is something that is really important when you think about preservation. You're thinking about, how can I preserve the wealth that I have for a long period of time? And then the next thing you have to think about, and this is very important, is that think in decades. This isn't about, patience. It's really about math. So the returns you'll get in like a 1 to 3 year frame is not as, you won't get as much if you're thinking like, you'll get way more, sorry, if you're thinking 10 years, if you're thinking 20 years. That's how the ultra wealthy start thinking about. So they're thinking about, like, in addition to preservation of capital, it's thinking in decades. So I'll give you a real life example, right? In 2014, in the Phoenix, Arizona, the apartment complexes there, their purchase price was about like 120,000 per door per unit. Now, these ultra wealthy, some of these ultra wealthy investors, they held those portfolios for like 12 years. And the current value right now is like 375,000 per one unit. That is around like 400% return on investment. And why is because, like, when they think about like the right places to buy, and that's something we'll talk about, right? They're buying based on demographic trends. So they're focusing on population growth. They're focusing on like market targets, which have like significant job diversity. They're also looking for like infrastructure. So when they're thinking, even though they're thinking long term, there's still fundamentals in their thinking. And I'm going to give you just a way to really think through when you're thinking about assets to buy. But that's how that you think about. So think about wealth. You're thinking about preservation first, and then you're thinking about like thinking in decades. And then the next one you're thinking about is like tax advantage growth. how can you start compounding the effect of those tax advantages? So you're thinking, the ultra wealthy are thinking, um, in depreciation. So in like if with an 8% return, right? If you invested, let's say just we use 10 million because it's easy math. 8% return is about 2.1 million, right? But then if you think about it, they're thinking about tax advantages. So they're thinking about depreciation benefits. They're also thinking about cost segregation benefits as well. They're thinking how can they move money that they're not really using right now from one property to another one through 1031 exchange. But this is how they're thinking about also using their tax advantage growth in order to grow their wealth. And so we're going to talk about Growth Parkview, which is our current investment opportunity. And that embodies all these three pillars that I just told you about. So we have like preservation of capital. We just found out that property is actually worth $60 million and we're buying it for 49.1 million. So right there, we're already having like preservation in our hard asset. And then think in decades. So think about like in that property, there's been 40 years of economic life in it and it's continuing to grow. And when you think about like tax advantage, we are doing full cost segregation on the property. And all of those is just how we're thinking, like the ultra wealthy is thinking. And they're not thinking quick. I'll say this again. They're not thinking quick. They are thinking get rich slowly and then stay rich forever. And I see questions in the chat. I'm going to answer all of those. But so when you think about this, I'm going to spend a little bit of time on this slide. I told you it was these two slides that I'm going to spend some time on, but this is the kind of insight that is usually reserved for the ultra wealthy, right? And the first one I said is like really focus on preservation. And that's thinking like, how can we preserve this while it's growing? So when you think about normal investors, right, they're thinking a 50% loss will require 100% gain just to break even. But when the ultra wealthy are thinking preservation, they're thinking, I'm not going to try to lose 50%. I am okay with like 15% loss, worst case scenario. And when you average that over a long time, while others are losing like 45%, they're only losing like 19%. I said it before, I'll say it again, think in decades, not quarters. So, and that's how that will play out in practice, right? Because you'll see that like ultra wealthy investors are holding, property. They're not doing 1 year, 2 year, they're thinking 5, 10, 15, because it's in that lengthy period of time that you can really focus on demographic trends. And then you don't have to deal with all the market cycles that come like every few years. And then they will accept like a 68% annual return. If that means that if you hold the property or whatever it is for over 10 years, you're getting like a 15% average annual return. I'll say it again, think long term. And then we talked about seeking tax advantages. It's very important because like every 1% that you save in taxes, it's actually almost like an extra 20% in wealth over 20 years. And those are like some of the specific strategies that we talked about, which is, cost segregation to accelerate depreciation. So how much can you get back in year one in taxes? Think about 1031 exchanges. So instead of paying capital gains now, you can take the profit that you got from a property and move it into another one. That's something to think about. Then another thing that's very, very important is to prioritize hard assets. And that matters because like hard assets, they will typically, they'll appreciate 2% over inflation every time. And so that's something to think about when you're like, where do I really want to invest my money? And you can see like there are different types of hard assets that you can benefit from. And then when you think about hard assets, the reason why they're so good is because you benefit from appreciation. You also benefit from cash flow. You benefit from the tax benefits and then the debt pay down. All of those things are really important when you think about prioritizing hard assets. And then the last one, which is you have to make sure that you're getting cash flow. So this is a non-negotiable. In everything that you're investing in, you need to make sure that you're getting cash flow. And the ultra wealthy, they're okay with like a minimum of 6%, 7% cash yield because it's over time. But then with cash flow, you also need to be getting monthly distributions or quarterly distributions. Those are all the things that will keep adding. So when you're thinking about these principles, you're thinking compounding, one thing stacking on top of the other, stacking on top of the other. So I want you to, as I'm telling you all these principles, right, what I want you to do is to be thinking, how can I implement this in my own portfolio? And if you're just starting out, that is still okay. The best time to have started was 10 years ago, but the next best time to start is today. That's what you have to start thinking about. And also, I want to say, like, all of these principles, they really build on each other. And I think that's the most important thing. So we just talked about the principles, right? Now I want us to shift to the silent killers that most investors never see coming, that is actually hurting them. And while other people make this mistake, you're here today, so you'll know better. And once you understand these things, you will think about investing a different way. So I gave you principles, and then I want to make sure that that these things are not hurting you. And number one is relying on the stock market. The second one is ignoring inflation. You have to pay attention to it. The third one, which we have talked about, touched on a little bit, is missing all the tax advantages that are available to you. And the fourth one is like neglecting alternative assets. So where else can you put your money? So I, in the last 20 years, I want to share with you kind of what has happened in the stock market, right? You will see something, you'll hear something that's a little shocking, because the average investor earned just around 2.9% annually, while the stock market actually returned about 8.7%. But what's really interesting is that, like, when you look at the numbers, right, the S&P 500 actually had negative returns 7 out of those 20 years. And the average recovery time for every time there was a dip, every time there was a drop, was about 3.1%. And even in like tech savvy portfolios, they saw a drop in about like twice, they saw like a 70% drop in that 20-year period. So that's why, like, it takes longer for you to recover during those recovery periods, and it's a lot. So it's not just about the drop, but it's about the opportunity cost that happens during those recovery periods. So when you think about it, like, diversification is also just as important, and that's another thing that, like, the ultra wealthy really understand. In 2008, what we saw was that the stocks, they fell about 37%, and bonds fell. The bonds also fell, but they fell closer to 20%. And in 2022, stocks and bonds also dropped simultaneously. But the ultra wealthy, they kind of approach things a little differently. So, like, instead of only dividing their money into stocks and bonds, they divided it into other additional profit centers. So they're also investing in stocks and bonds, but the percentages are different. And so what they did instead was they did about like 35% in public markets, but then they did almost close to 42% in like income producing hard assets. So think apartments, think storages, think just different other like hard assets, as opposed to just stocks and bonds. And then they also did a little bit of like private market opportunities, and just very little in like cash positions. And because they did this, while others lost about 45%, they lost about 19%. And that is okay. But like in 2022, some of them gained and didn't lose anything at all, while we still struggled with like a 28% loss in our traditional portfolio. So, and that's what you have to think. So when you're looking at opportunities, you have to make sure that you're looking at opportunities that don't correlate with the stock market. You're also looking at opportunities that are giving you monthly, quarterly cash flow. You're getting distributions, and then you have hard assets that are backing, your investments, that are not, they don't fluctuate with every single market sentiment. That's how you protect yourself. So what if I told you that a 7% return could actually be losing money? You're like, oh, I'm making money, it's a 7% return. But I want to show you something that changed how I really looked at wealth preservation. And that is something called, well, when we think about the silent wealth killer, right? What's really happening to your money? When you think about, like, when we talk about inflation, so $1 million in 2000 needs to be about like 1.78 million today. So around like 1.7 million to buy the same goods that you would have bought for 1 million in year 2000. And then also in the last 3 years, right, real estate taxes went up, but also not only that, insurance premiums also went up, and insurance premiums went up by like 30%.